Live from Singapore, welcome to our new show, diving deeper into the stories that matter with crucial context and sharp analysis. This is Insight with me, Haslinda Amin. Tesla electrifies the Magnificent Seven, kicking off their earnings season in style with a blowout quarter and some bold ambitions for 2025. We speak to Lombard Odier's John Woods about why they think Japanese stocks are a win-win as we get closer to U.S. elections. Also ahead, Chinese President Xi Jinping meets Indian Prime Minister Narendra Modi at the BRICS summit as the two countries stabilize ties after years of tensions. A former Indian envoy to the United Nations joins us to explain why it'll take more time for trust to be restored between New Delhi and Beijing. And we have an exclusive with LinkedIn CEO Ryan Roslansky, who tells job seekers to embrace the change brought on by the rise of AI. Well, Tesla's strong quarter has helped lift sentiment for U.S. stocks futures after a weak trading session. Bloomberg's Avril Hong has the details. Avril.
Yeah, Has. I mean, you think about it, going into this earnings scorecard, the expectation from consensus was that Tesla would fall even further behind big tech. It is, after all, seen as the weakest link among the Mag 7. So having these earnings beating expectations, we're seeing a strong quarter, we're seeing that being lifted by sales, that is helping to boost the sentiment on the streets. But we also know how Tesla does have a tendency to overpromise, underdeliver. And if you think about how the recent robo-taxi, that announcement was a bit of a flop, that really enhanced the scrutiny. Investors wanted to see that it was doubling down perhaps on its bread and butter business, electric vehicle sales. Let's take a closer look at the numbers because this is the first beat in 5 quarters. Note here though that the bar was low going into this because estimates have about halved in the past year. And if you think about what Elon Musk has said, yes, I think he is promising delivery growth of 20 to 30% in the next year. There is also talk about ride-hailing in Texas and California. Keep in mind, he does have a tendency to overpromise, underdeliver. And I guess if you take a look at the price of the stock so far this year, that also is reflected. It's down about 14% so far this year, despite that post-market surge. Think about also how it is so expensive compared to the Mag 7s. I think the most expensive at about 70 times forward earnings. So keeping that in mind, I think it's fair to say that Tesla does still have some work to do to prove that it is worthy of being part of this exclusive group, the Mag 7s, Has.
For now, though, party in the street, we're seeing a massive rise. After hours, more than 11%. Avril Hong, we thank you so much for that. Now, let's deep dive into Tesla's earnings with our next guest, who has a neutral rating on the company. Andres Shapit is Senior Equity Research Analyst at Cantor Fitzgerald. He joins us from New York. Andres, good to have you with us. We know that, when it comes to Elon Musk, he's pretty upbeat in terms of the prospects for the company. Wall Street is, partying on the back of those numbers. Are we seeing a solid turnaround for the company?
Yeah, well, good morning, and thank you for having us on. It's great to be here. I agree with what was just said in your program. This quarter was, in fact, a very strong quarter for the company. Revenues were roughly in line, but really the story, in our view, was the impressive outperformance in margins. Both adjusted EBITDA margins and gross margins fairly exceeded expectations. In our view, the company is currently undergoing through a transition phase as it looks to ramp up its robotaxi and its FSD software. And that's really where the excitement will come. Today could be a step in the right direction.
You talk about the robotaxi. I mean, you were there for the launch that happened recently. What's your take on it? How convinced are you about this strange change in strategy?
Yeah, as you pointed out, we did get a chance to attend the event back on October 10th, and it really was exciting to see the concept of the robotaxi unveiled. As we know now, this is a two-seater, fully electric, fully autonomous vehicle that doesn't feature a steering wheel or pedals. So that might take some getting used to. I think what was disappointing from the event, at least in our view, is that the company still, including today, has not fully quantified what that initial fleet size would look like or the exact timing of that rollout, other than to say they will start in California and Texas, and that production is expected to ramp up before 2027. But we know that Elon sometimes has some goals that are a bit overzealous, and so we'll have to see whether the company can meet those ambitious timeline.
Well, the thing is, Andres, Elon Musk is putting a lot of resources into this particular business. You got to wonder if it's going to be a game changer eventually. If you're not convinced now, what would it take for you to be convinced?
Well, I think it's very impressive to see what they've been able to achieve with the use of cameras. And the FSD software today is fairly advanced, and that the car can essentially do all tasks that are required. Our questions will come: what happens in situations of inclement weather where visibility might not be all that great? How will the cars perform then? And the reality is that we don't yet have answers to those questions. But it is an exciting technology, and it's certainly impressive to see what they've been able to achieve through that use of camera and without that use of LiDAR. And so we expect to get a few more details as the company continues to ramp up. It's an impressive product, and it can certainly be an important revenue segment for the company over the medium to long term. There's just a few questions yet that are left unanswered.
There's a lot of fuss over the lineup of EVs for Tesla. Are you as pessimistic when you take a look at that?
Well, I wouldn't say that we're pessimistic. The company on its Q3 earnings call earlier reaffirmed their expectation to begin production of their lower cost vehicles. And that is targeted for the first half of 2025. We see that as an important inflection for the company, since that more competitive price point, they should experience a bit of a surge in demand. So we are excited about that prospect. We learned on the Q3 call earlier that the Cybertruck has now also achieved positive gross margins, which is exciting. And so we are encouraged by their products. I think the next level of growth for this company will come down to how quickly they can adopt that FSD, what that penetration will be, particularly as they expand into China, and as they get closer to that introduction of the lower cost vehicle and to the robotaxi. That's where the excitement will come in our view.
You talk about China. How important is the Chinese market for Tesla?
Well, we would say it's fairly important. China historically has accounted for about 20% of total revenue. And as we know, it is the most advanced EV market in the world today. And so it is something that will play an important part in Tesla's growth. We'll just have to see whether geopolitics play a factor there.
Now, the thing is whether China can counter the margin squeeze that Elon Musk is experiencing, the margin pressure. Can China counter that?
Well, they have proven that they are able to introduce EVs at very competitive prices. And so they can certainly compete. And, the likes of NIO and BYD, which we don't currently cover, but they have been impressive in how quickly they've been able to ramp up growth. And so it is possible. And that's where the big competition with Elon and Tesla will come from.
Andres, thank you so much for your time. There you have it, Andres Shepard, Cantor Fitzgerald. Now, onto another top story we're tracking. Boeing factory workers have rejected a new labor contract offer and will remain on strike, dealing a fresh blow to the struggling plane maker. About 64% of union members who cast ballots Wednesday voted against the tentative deal. The contract would have raised their wages by 35% over 4 years. And still to come, more analysis on Tesla's earnings and the broader rally in big tech. Lombard Odier's Asia CIO, John Woods, will be joining us next. Keep it here with us. This is Bloomberg. Welcome back. Ahead of Tesla's earnings report, investors saw it as the weakest link in the so-called Magnificent Seven. But could a blowout quarter for the EV maker be a sign of resilience for the tech giants? Let's discuss this and more with John Woods, Asia CIO at Lombard Odier, of course, joining me for the first time in the same space. Good to have you with us, John. I mean, we've had a lot of guests coming through saying that, you know what, you can't go wrong betting on Mag 7. Never mind the rally we've seen so far. Do you agree?
Well, I think it's a key part of a portfolio, but what we're seeing, and I think it's slightly more exciting, is a broadening of the performance of the S&P rather than just a narrow concentration. I think as the soft landing thesis gains traction among investors, we start to see a rotation away from a very concentrated holding across particularly cyclicals. And essentially a broadening and deepening of the investment proposition. I also see, for example, increasing interest in emerging markets, and it's been a while since that's been the case. I think it's a positive thing. I think that, yes, absolutely, we're in the foothills of the AI revolution, but I do like the idea of a greater depth and diversity for investors being acceptable now.
So don't chase the rally, don't buy the dips?
You know, we're being a little bit neutral ahead of the election. I think it has potentially binary consequences for a number of sectors and also not least monetary policy. So we're actually neutral heading into the election, and we'll wait until afterwards before we start selecting sectors and strategies which we think will outperform.
So the US election is the biggest risk, at least in the short and medium term. How are you positioning for that?
Well, there's event risk in Israel's potential response to Iran as well, which is somewhat concerning us. But as far as the election's concerned, we are taking a 50-50 view right now. I think it's far too difficult to pick a winner. You know, when you are in wealth management, when you are the trusted advisor of family wealth, you tend to allow someone to cross the road first, even second.
Take a cautious approach.
Exactly. I would rather not take a speculative view on the consequences of either a Harris or Trump victory. I think there's plenty of opportunity to ride momentum after the election.
But how do you hedge against those risks?
Well, through typically a diversified, balanced portfolio.
Which looks like how?
Well, I mean, if you look, for example, at the performance of equities year to date and the performance of fixed income complex year to date, that is a classic example of a 60-40 portfolio, Haslinda, and also actually the clear pricing and of a soft landing. I look at a broadening and deepening of the equity complex. American exceptionalism clearly is out in front, but at the same time, you've got performances by Japan, by certain European countries, by small and medium-sized companies, which is the first time in a while that's been the case, and as I mentioned, emerging markets. So I see no real risk of recession or indeed inflationary shocks in that performance. In the fixed income complex, we've had a reasonable performance from high yield and investment grade. And I think as investors anticipate this rotation from money market funds, this so-called $7 trillion mythical dollars in money market funds rotating into investment grade, that's going to outperform as well. So you ask how my portfolio is looking right now. Actually, it's overweight investment grade and high yield. It's overweight markets like Japan, anticipating this rotation to countries outside and opportunities outside the narrow Magnificent Seven.
You talk about rotation, you talk about emerging markets. We're seeing that rotation actually from India to China. The question really is whether that is sustainable. Do you see that persisting?
Well, there's been obviously a huge amount of expectation in China. The type of sharp rally that we've seen before, not least in October last year up to around the January-February time. But the problem is there tends to be a lack of follow-through. We've noticed in China. And again, I'm happy for investors to cross the road first, maybe second. And I will wait until I see substantive, meaningful fiscal policy that will follow up on the sugar that's been poured on the markets before making a decision.
What does that look like? Because some people say that we're already beginning to see that, right? When you take a look at fiscal stimulus, according to some calculations, we're already seeing about 10 trillion yuan, which is the magic number that the market's looking for.
Well, I think the market's probably a little ahead of itself, actually, on the underlying announcements thus far made. And so there is the risk, obviously, of a pullback if the market's somewhat extreme expectations are not met. But really all the focus is on the property sector, in my mind, how the government is going to absorb and manage these so-called 46 million paid for but unbuilt homes. That to me is the massive overhang in that sector. And until we see, I think, some meaningful policy to address that, there's still going to be some concern about whether or not this is going to be yet another one of those spikes higher in the equity markets and again subsequently eroded over the subsequent months.
People are beginning to talk about playing EM without China, EM ex-China. And there seems to be some traction in that. What do you make of that trend?
We see it as well. I mean, we see a substantive amount of interest amongst clients for EM ex-China. And in particular, a focus critically on the US dollar, because as we generally appreciate, when we have a weaker dollar, we tend to have investors rotating out of US dollar holdings, seeking growth and earnings in other currencies, particularly Asian currencies. And that's when you tend to see a surge in risk-taking. So absolutely, if we were to see, for example, a Harris victory, who possibly doesn't carry the same inflationary consequences as a Trump administration, then I think we will start to see some weakness in the dollar potentially into 2025. And I think that would ignite a bout of risk-taking in emerging markets as a consequence.
Would a Trump presidency mean further weakness for Chinese stocks, given the tariffs that could potentially be slapped on Chinese companies?
I mean, you'd have to think they're not positive, right? I mean, you'd have to think that if he follows through with this idea of a 60% tariff on Chinese exports to the United States, it clearly is not going to be positive. I mean, it will have something between 1% and possibly 2% impact on GDP. They won't happen immediately. It's likely that those tariffs won't actually be implemented until the back end of next year, possibly into 2026. But nevertheless, there's an overhang, and obviously that will start impacting the expectations of foreign investors. Actually, I don't think the Chinese authorities will really unveil the bazooka until after the US election, if there is a Trump victory. And the market pricing seems to be tilting in that direction. But if there is a Trump victory, then I think they will have to stand up and make a meaningful commitment, particularly to this fiscal stimulus story that we're talking about. And I think then if it's a credible set of policies, investors such as me, that the wealth management team will start looking at it more seriously.
Given the cautious view on China, would India be a more convincing longer-term play? We're already beginning to see that, yet when you take a look at investments pumped to India in terms of a portfolio perspective, it's still pretty minuscule.
It is. I mean, when I look at the Indian investment complex, I see it overwhelmed by services. I see very little manufacturing in there. And as I see the march and acceleration of AI, it worries me that some of the franchise, the services franchise in India could easily be eroded by the development and acceleration of a rollout in AI. It's also an expensive market. And you know, when you are like me, which is a regional allocator, I will look at every single market around the region and cherry pick those which I feel offer the best risk-adjusted value. Because India is such a domestic market, it tends to have its own valuation standards. And compared to the rest of Asia, actually, it's actually quite rich. So yes, I think there's a strong story, there's a demographic story, there's a growth story, there's a positive inflation story. That all works. But these valuations are so high, it makes the earnings story just a little bit more challenging. And, you know, when you are a fundamentals investor, that's something that you have to consider.
How much of a correction in India would prompt you to look at Indian stocks?
I think a 10% pullback is something that would then catch the eye. But again, my sense is this is very much a stock picker's story. It's looking at sectors and names which we feel are undervalued and likely to benefit subsequently from this accelerated growth outlook, and particularly preparing for what we hope is additional FDI inflows, because I think that could be game-changing.
You talked about how India is more a services story, not a manufacturing story. We're seeing a thawing of relations between India and China, and that may pave the way for manufacturing to play a bigger role in the Indian economy. Is that a game-changer for you?
That's a really good point, Haslinda, because, you know, I'm going to exaggerate to make a few points here, but manufacturing as a proportion of GDP in China is probably sort of 70–80%. Manufacturing as a proportion of GDP in India is probably 15 to 20%. So there's a very substantive difference in economic structure. So yes, I think if there is the possibility of some reshoring from China to India, it can only be positive. And I think this is where the sort of China or India narrative starts to blur. I don't think it's as simple as one or the other. One anticipates actually greater cooperation and greater partnership between those two large nations as they seek to leverage off each other's advantages.
You talked about Japan earlier, how you're pretty upbeat about the Japanese market as well. Of course, front and center is what the BOJ would do next. What are you looking at?
Well, I think another 25 basis points probably in December is baked in the price, probably also necessary to draw a line or at least provide some support to dollar-yen. Again, our optimistic view on Japan is somewhat neutral, actually, relative to the election. If Trump comes in, we see the likelihood of dollar strength as being more possible, and then subsequently a weak yen tends to be positive for the equity market. If Harris conversely comes in, it's quite likely that the tariff risk, 10% tariff, which could be imposed on Japan, will also be eliminated. And then I think that will be largely positive over the medium term for Japanese equities. It's not so much a compelling valuation story. It's fairly valued right now. But my sense is this resurgent consumption story in Japan, likely to benefit corporate revenues, likely to benefit corporate earnings, is what's going to drive the market. And by the way, I think that's largely independent of movement in the yen. My sense is that we will return to this environment of equity strength and possibly even yen strength as we did 20, 30 years ago.
So what yen level are you looking at when you talk about yen strength?
Well, I mean, I think that if we were to stabilize around the 130, 135 level, that would be a period of consolidation after this volatile movements we've seen over the last year or so.
All right, John, great to have you with us. John Woods, CIO Asia at Lombard Odier. Before we go for a short break, let's take a look at how Asian currencies are doing at this point in time. We talk about the yen. Let's take a look where the yen is right now. Of course, it's breached 153. Let's take a look where it is right now, 152.41. Lots of talk about possible intervention. Some say unlikely to see that till we see 160. In terms of the Aussie dollar, 66.50 versus the USD. Well, still to come, LinkedIn CEO Ryan Roslansky tells job seekers to embrace the change brought on by the rise of AI. More from my exclusive interview next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight, and Chinese benchmarks heading to lunch break. Let's take a look at how it's faring. Of course, we know that China under pressure. Currently, the CSI 300 index down about 0.9 to 1%. The concern is about its economy. The focus is on stimulus. Investors have been talking about that 10 trillion yuan stimulus, how that will play through the economy, and we'll wait and see how China manages that. In terms of the HS Tech index, it is currently seeing some weakness as well, currently down about 1.5%. And the Chinese yuan, 712.42 is the level we're looking at. It is up versus the USD by about 1/10%. Now, speaking of China weakness, China weakness is a growing concern for European luxury retailers. Avril Hong has been looking closer at this, and it seems like everybody's kind of like paying the price for it.
Absolutely, including European luxury retailers, which for a while looked like they were holding out, looking pretty resilient. But recently we heard how the likes of LVMH, that showed up in their numbers. I mean, you think about for sales of its fashion, its leather goods, that slump there was for the first time since the pandemic. And the latest to kind of succumb to this trend is Kering, which of course houses Gucci under its umbrella. It saw its third quarter sales down, including at Gucci. I think profit was the lowest since 2016. Its CFO kind of highlighting the China concern, saying it's very hard to ascertain what China's stimulus is going to be on the impact for its demand next year. And we already have the likes of Bloomberg Intelligence telling us that the pain is not over yet. For Kering in particular, they actually see more downgrades for 2024 in terms of sales, in terms of gross margin as well.
So a lot of clarity that is needed for the market. I'm just wondering, in terms of Kering's challenges, they're pretty unique.
Yeah, I mean, it also has some brand recognition or brand elevation that it needs to do. I think the top leadership has been tasked with kind of reinforcing its position as a luxury label and moving things up. But so far, nothing has really bitten. It hasn't made much headway in that direction. And this is, I think, adding to the challenges for Kering, lifting Gucci's appeal and then, trying to kind of counter the weakness out of China as well.
So Kering pretty cautious in its outlook. How about Hermes? This is one brand that's traditionally done pretty well.
Yeah, we've seen how it's been pretty resilient. I mean, you think about how among the luxury retailers, it has a loyal following, I think yourself included. And, it's got all these exclusive products. So it has been faring a lot better than many of these other luxury retailers. So even though we have like Morgan Stanley showing us how, I think from the China revenues, it accounts for about 40% of its sales versus some of its other peers at around 30%, that brand recognition is really what's helping Hermes to, stay ahead of the pack. But you think about how the luxury slump is deepening. We have Bloomberg Intelligence also telling us that it is unlikely that Hermes can remain immune to that. And I think it is likely to face, or at least the estimate is that it could face its slowest quarter in years, Has.
So even Hermes is not spared, not even the Birkins and the Kellys can help. Avril Hong, thank you. Now, LinkedIn says the labor market is brimming with change thanks to the rise of AI. CEO Ryan Roslensky told us exclusively how the new technology is being used in career development as younger users fuel a content shift.
We have over 1.1 billion members. 7 people are signing up for LinkedIn every second, and 140 million of them are in India. We're seeing tremendous growth in the product. Not only people signing up, but the Indian population is over-indexing on all the things that really matter for someone to navigate their career. They over-index on networking, they over-index on job searching, and they over-index over 50% versus anywhere else across the globe on learning. It's a culture that's really, you can just feel the energy when you're there. People that are really trying to move the economy forward, the labor market forward, and there's just a lot of excitement and energy in India right now.
Is there anything you're seeing in India that is a reflection of the rest of Asia or the world in terms of trends that you're seeing from the data that you have?
Well, one of the things that I've learned a lot while I'm in Asia this week that I didn't think I'd recognize before I came here was we've historically built LinkedIn, and I think a lot of folks in the Silicon Valley have built products with the US user in mind and then figured out how to scale that globally potentially. What's happening right now, and especially in India and Indonesia with the younger population, they're starting to lead the trend on how technology can and should be used. So I sat down with a bunch of creators in India yesterday who are using LinkedIn to share professional video on the platform. And the insights that I got out of these folks in India, I think are going to be some of the things that lead the way for how the entire product will work moving forward. So now, for the first time, there's been a focus on real India or, Indonesia leading the way in terms of what the product portfolio looks like. So that's one insight. Number two, if you take a step back on LinkedIn, I mean, underneath that graph, there's a ton of data. We call it the economic graph, 1 billion people, 65 million companies, 20 million jobs at any given time. And the connection of those things is moving really quickly. So we see real-time labor data across the globe. And the thing that I'm paying a lot of attention to, especially as it relates to AI, is the fact that even if you're not changing your job is changing on you. So take an average job in India today. The average job, your job, my job, anyone's job, the average job title versus 2016, the skills needed to do that job have changed by 40%. By 2030, it will probably be 70%. So we're going through this period right now where there's rapid evolution, be it due to, COVID or digital transformation or a fourth industrial revolution, that jobs are changing at a much higher rate than we've ever seen before. And I think it's only going to keep going.
When you cull that data, what does it say about the various labor markets? I mean, you talked about the Indian market. I mean, how are you looking in terms of the Asian labor market versus the U.S. labor market right now, which is in focus for a lot of the companies?
So I think, a couple of the trends that we see right now are, across the board, just the need for, people to really upskill in what they're doing. AI skills, but also human skills, I think are really in high demand across the board. For the first time on LinkedIn, we're seeing a lot of growth outside of kind of the core knowledge worker, and that's especially happening in India and Indonesia. So small business owners, freelancers are really starting to gravitate towards the platform. So, the more people that join 7 per second, just the more insights we have across the globe. And it's really interesting to see those patterns. But, for me, really the idea that, again, if you're not changing your job is even changing on you. It's just a really important thing for people to grasp right now, especially as AI takes more shape in the labor market.
So is the labor market resilient, for example, in the U.S.? Is there any indication to show that it is?
I think across the U.S., it feels very resilient. It feels more resilient in certain sectors like healthcare and manufacturing. It felt less resilient a year ago in tech, but tech's feeling much more resilient, especially in the AI sector, especially in Silicon Valley than it did a year ago. So I'm seeing some decent strength in the US market right now.
So you talk about how the Asian market is really strong, and I can only imagine you want to grow it. What is the strategy that you want to implement in this part of the world?
One of the things I've learned for sure on this trip is just how important small businesses are in Asia. We've historically, focused the LinkedIn platform on our customer base on larger enterprises. And for us to really break through in Asia, the focus on small business is going to have to be a key. Then secondly, the labor force in Asia is, it's just a much younger labor force that is used to navigating any product, any kind of social product through video is the medium by which they consume or share content. So a real push into video as well, and short form video on LinkedIn is going to be an important way to help professionals stay informed on the platform, make connections and grow their network through video as the medium.
Right now, there's a lot of focus on the US election and perhaps AI-generated misinformation. How are you countering that on your platform?
To a large extent, LinkedIn exists as a platform to create economic opportunity. What you share on LinkedIn is attached to your real identity, your resume online. So we don't face a lot of the issues that a lot of other platforms may face where there's not real identity. But to the extent that, we still have a lot of the same, trust in place across the board, through AI and human review, things get reported, but there's not a lot of political content on LinkedIn. In fact, in 2018, we actually, disallowed political advertising altogether on LinkedIn. So it's not really a place where, politics are happening.
From the data that you've collated, from the trends that you're seeing on LinkedIn, what would be the jobs of the future?
It's actually, it's something I spend a lot of time thinking about, both as the CEO of LinkedIn, but also, as the father of an 18-year-old daughter that just started college. And it was just 2 months ago, I was sitting around the dining room table with her and a bunch of her friends. They were asking me, hey, as the CEO of LinkedIn, are we going to have jobs, in 10 years, or what should we study in college? And my advice to them is, you're entering a labor market that is brimming with change. But with that change comes real opportunity. You have to think differently, though, about how to navigate your career these days. And I think about 3 things that really matter. Number one, the most important skill that matters right now in the world, in my opinion, is, quite frankly, learning how to learn, being adaptable, embracing change. All these new AI tools are coming out. When they come out, learn them, use them, try them. If you're stuck in the old ways and the world's moving around you, you're not going to be successful. Number two, don't forget the human element, compassion, empathy, human judgment, ethical judgment. If you can get really good at those things, understanding how to communicate, that can really help you stand out in the labor market, because it's not just going to be about AI. And then most importantly, what I'm really excited about is, especially with these, these young women I was talking to, in my dining room table a few weeks ago, these are kids who aspire to do great things in the world. Solve problems like climate change or, healthcare or disease prevention. And AI and some of this technology is going to allow things that were once unimaginable, even a few years ago, to be tackled. So use that excitement and that youth and that, desire to change the world for positivity right now, leveraging these tools to do that. I think it's a real opportunity to change the way the world works right now.
The human touch still matters. LinkedIn CEO Ryan Roslansky. Still to come, India's former envoy to the United Nations joins us to discuss relations with China as President Xi and Prime Minister Modi hold their first talks in 2 years. Keep it here with us. This is Bloomberg. Chinese President Xi Jinping has met with India's Narendra Modi in their first face-to-face talk since 2022. The meeting comes after they eased a 4-year border stalemate. For more insight, joining us now is Syed Akbaruddin, former Indian envoy to the United Nations. Syed, good to have you with us. I'm wondering, what's your perspective on this? Is this meeting as significant as it's touted to be?
Well, India and China are unique nations. They are the only two countries in the world with populations of 1 billion plus. There are the leaders of these two countries haven't met in a formal interaction over the last 5 years. So obviously, things had not been in good shape for at least last 4 years. So a meeting now augurs well for both of them, especially because before that they had met 18 times. So you can see that there was a disconnect in terms of communication at the top level, and that's been restored. So it's a good augury for things to come.
The thing is, what do you make of the timing? Why now? Is it a situation where both sides want to focus on their respective economies and better relations between the two would help them do that?
Yes, that's certainly one of the factors that accounts for this change. India has been basically making the point that unless there is peace and tranquility on the border, other areas of cooperation would be adversely affected. China is in a difficult situation economically. India is in a global sweet spot. It wants investment. It wants to increase its economic cooperation. So there are imperatives of an economic nature, but then there are also geopolitical imperatives because India sees itself as straddling the global divide. It wants to benefit from both sides. So I think there are geopolitical as well as economic reasons for this.
You talk about economic reasons. We know that Modi wants India to be a manufacturing hub, and it's going to be difficult to achieve that goal if there's no Chinese investments, particularly in manufacturing. Isn't that true, Syed?
Can you repeat it?
Isn't it true that Modi needs Chinese money for him to realize India's ambitions to be a manufacturing hub?
Sure. India needs everybody's money because the requirements are such that investments from everywhere are welcome. But there are challenges with those investments because today, I would say, commerce has been weaponized. So while we need money from everywhere, We will also be very careful in ensuring that it's not weaponized to the detriment of the country. And this is normal. This is what's happening. We are weaponizing many things, securitizing many things. So there is a desire, but there's also cost with that.
Syed, do you think the upcoming U.S. election is putting pressure on the two sides to come together? A Trump administration, for instance, may cause more chaos in the international scene, so the two sides might as well have better relations.
So India has been, as I said, in a geopolitically sweet spot. Its relations are bipartisan as far as the U.S. is concerned. In the last Trump administration, India had the best of ties with the U.S. So if there is a change in the U.S. Presidency, I do not think it's going to fundamentally alter the trajectory of India-U.S. ties, which have been on a glide path for almost 20 years. So I don't see that as a major factor, but of course, global risk always is there because the concern perhaps would be that trade may be affected in different ways, not directly with India, but global trade, and it's always good to hedge in times of uncertainty.
Syed, thank you for joining us. Syed Akbaruddin, former Indian envoy to the United Nations, rather. Now, U.S. Trade Representative Katherine Tai says the Biden administration is committed to inclusive trade policies, despite efforts to crack down on alleged Chinese overcapacity. She spoke to us at the Bloomberg New Economy event in Brazil.
In terms of the path forward and the work that we have to do as the United States in partnership with our friends and neighbors, I think that we have a lot of common ground to be thinking about how you use trade policy and trade tools to develop, enhance, and reinforce inclusive economic institutions.
I guess a lot of people listening to this will see here something that we see quite a lot in the Biden administration. It feels like there's an intellectual structure being built to defend a basic sort of political impetus, which has been led by former President Trump, that we just don't want Chinese-made cars flooding the US, whether it's from Mexico or from China. And he doesn't talk about the resilience of supply chains. He just says he doesn't want them and he's going to put 1,000% tariffs or 200%, it varies. I know you can't get into the campaign itself, but it feels like a lot of this is all about trying to make it harder for Chinese cars to get into the US one way or another. And ultimately, that's also going to trigger a review of the trade agreement.
Well, Stephanie, I feel like the way you've posed that question, while very, very friendly and with a smile, is in a way challenging whether or not I've been lying to you for these 20 minutes. And I just want to say...
Providing an intellectual justification for a political policy.
I mean, I think if that's what you've taken away from this conversation, you've really missed everything that I've just said to you.
Okay.
Which is, it's an intellectual framework that is placed in objectivity, that is not xenophobic, that is not about keeping the PRC down, but is about growing inclusive economies at home so that the parts of our population and our fellow Americans, our fellow Brazilians, who are really struggling today, struggling even more than they were before the pandemic, before the great financial crisis, and before the takeoff of this era of trickle-down trade policies has hollowed out significant parts of our economy. And I know that in Brazil, there is a huge, huge outcry when major auto manufacturers pulled out of Brazil and shut down production here. Those are not political. Those are about economics, it's about livelihoods, and it's about the ability of a democracy to deliver livelihoods and hope for its people. That is the whole point of a democracy. So let me just end there to say that an intellectual framework that we've put forward is undergirded by President Biden and Vice President Harris's deep conviction that our democracy and its economic promise that these are the most important elements of what we have to deliver to our people. In trade for a very, very long time, we've been concerned by the indications that we've seen of growing economic dominance of the PRC economy in the global economy, as represented by industries that have been grown strategically and intentionally, not just for dominance within the Chinese economy, but for global marketplace domination. We've seen that in steel, we've seen it in solar, we are now seeing it in EVs and batteries. And what I think is really interesting about today in 2024 is that across our administration, whether you're the US Trade Representative, you're the Secretary of the Treasury, whether you're the Secretary of State or the Director of the National Economic Council, we are all focused on this challenge of Chinese overcapacity, excess production.
And that was U.S. Trade Representative Katherine Tai speaking with Bloomberg's Stephanie Flinders. Let's take a look at how U.S. futures are looking at this point in time. We're keeping an eye on the markets as we saw that gangbuster performance from Tesla. U.S. futures currently looking like it will be in positive open, up 0.2% in terms of the dollar. 112.59 is the level we're looking at. It is under slight pressure, down about 0.1% in terms of the USD. And of course, we're taking a look at treasuries as well. We know the bond market has been repricing 10-year yields at 4.26, the highest we've seen since July. Of course, a repricing in terms of expectations of the Fed and what it will do in terms of the rate cuts. It may not be as much as people once anticipated. In terms of 2-year yields at 4.0651, 10-year yields forward 22.56. And before we go, here's a look at our guests for tomorrow. We'll get insights on the latest investment strategies with Aquamarine Capital founder and CEO. Here's why he's a big fan of Indian equities. Plus, the CEO of National Stock Exchange of India joins us exclusively to talk about what's next for the Boers after Hyundai's record listing this week. Also ahead, Episode 2 of Momentum. I head to Seoul to see how Korean culture is inspiring the next wave after K-pop, this time in architecture. You can stream it online or at the times listed here. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Lombard.